Assalamu alaikum warahmatullah. This is Faisal Ahmed. My student ID last 3 digit is 156. I am the member of Group 6. Today's my topic is measurement of risk-weighted assets, market risk. Now I explain it and its scope. So let's see. First of all, introduction. Market risk is defined as the risk of losses in on and off balance sheet positions arising from movements in market prices. The market risk positions subject to the requirements are: number one, the risks pertaining in interest rate related instrument and equities in the trading book, and number two, foreign exchange rate is risk and commodities risk throughout the bank, both in the banking and in the trading book. Its introduction of market risk. Then definition. Trading book consists of position in financial instruments held with trading intent on or in order to hedge other elements of the trading book. A capital charge will be applicable for financial instruments which are free from any restrictive contents on tradability or able to hedge completely. Generally, investments which are held trading and reality available for sale and major parts in the trading book. Then we see the financial asset is any asset that in cash, the right to receive cash or another financial asset. Financial liability is the contractual obligation to deliver cash on another financial asset or to exchange financial liabilities under condition that the potential unfavorable. Then heads is a position or the mentality or entirely offset that risk elements of another position in the trading book portfolio. So hopefully we know that what is definition of market risk. And the next one, scope. Scope and coverage of the capital charge. The requirement of allocated capital is in respect of issue to risk deriving from change in interest rate and equity price in the bank's trading books in respect to exposure in risk deriving from change in foreign exchange rate and commodity price in the overall banking activities. So let's see. There are 4 activities. First of all, one balance sheet assets held in the trading book are subject to only market risk capital requirements and will not be subject to credit risk capital requirement. And the next one balance sheet assets founded in foreign currency will be subject to both credit and market risk capital requirement. Number 3, derivatives. Derivatives, unless they are contracted to hedge position in the banking book, will be considered part of trading book and will be subject to both credit and market risk capital requirement. And the last one, repurchase or reverse purchase. Securities lending held in trading book will be subject to both credit and market risk capital requirement. And the last one, scope and coverage of the capital charge. For the charge, for the purpose of capital charge of market risk will include: number 1, securities include under the safety categories. The next, equity position and commodity position. Number 3, overall foreign exchange exposure. Number 4, trading positions and derivatives. And finally, derivatives for the purpose of hedging trading books exposure. So hopefully we understand it. Measurement of risk weighted assets and market risk. And last one, thank you, sir. Assalamu alaikum warahmatullahi wabarakatuh.
Assalamu alaikum everyone. I am MD Rifat Arifin Rafi. My university identification number 210137157. Today we discuss measurement of risk weighted asset market risks. This topic methodology. In standard approach, the capital requirement for various market risks such as interest risks, equity price risks, commodity price risks, and foreign exchange risks. Next topic, capital charges for interest rate risks. The minimum capital required is expressed in terms two separately calculated capital charges. 1. Specific risks and 2. General market risks. Next topic, capital charges for specific risks. This has three category: one government category, two qualifying category, and three other category. Government category are those security which included government of Bangladesh and foreign government. Qualifying category are two types: one, debt security issued by public sector entities and multinational development bank and other security that are recognized by Bangladesh Bank. 2. Debt security rated at least 2 credit rating agency that approve panel of Bangladesh Bank. And next, other category include those instruments which are not included in government and qualifying category. We saw next slide. A graph has remained capital charge widened for specific risks. There has many information such categories: Bangladesh Bank, rating grade, particulars, and charges capital widened. Thanks for everyone.
Hello everyone, my name is Sabin Hussain. I'm a student of Banking and Insurance in Rajshahi University. The last digit of my ID number is 158. Today we're gonna discuss about capital charges for general market risk. We're using maturity method here. The capital requirement for general market risk is designed to capture the risk of loss arising from changes in market interest rates. Positions are allocated across a maturity ladder and the capital change is then calculated as a sum of following four components: the net short or long position in the whole trading book, a small proportion of the matched positions in each time band, a larger proportions of the matched position across different time bands, and lastly a net charge for position in options where appropriate. Now we're gonna see time bands and weights. Here we're given various zones: time bands for coupon 3% or more, time bands for coupon less than 3%, and capital charge weight. For zone 1, and if it's 3% or higher coupon rate, then we have 1 month or less to 6 to 12 months. If it's less than 3 months, a 3% coupon rate, then 1 month to 12 months. And capital charge weight begins from 0% to 0.70%. And for zone 2, we have 1 to 5 years, and for less than 3% coupon rate, we have 1 to 4.3 years, and 1.25 to 2.75%. And for zone 3, we have 4 to 5 years to over 20 years. And for less than 3% coupon rate, we have 3.6 years to over 20 years. And 3.25% to 12.50%. That's all from me. Thank you everyone for listening.
Hello everyone, welcome to my presentation. This is Maisha Bashar, undergraduate student of Banking and Insurance Department, University of Rajshahi. Today I'm gonna talk about capital charges for interest rate risk. So let's get started. The minimum capital requirement is expressed in terms of two separately calculated capital charges for specific risk and general market risks. In today's presentation, I will discuss about general market risk. So, general market risk is applicable for the interest rate risk in the portfolio for long and short positions in different securities or instruments can be offset. Moving to the next slide, maturity method. The capital requirement for general market risk is designed to capture the risk of loss arising from changes in market interest rates. Positions are allocated across a maturity ladder and the capital charge is then calculated as a sum of the following four components. Number one, the net short or long position in the whole trading book. Number two, a small proportion in the matched positions in each time band, the vertical disallowance. Number three, a larger proportion of the matched positions across different time bands, the horizontal disallowance. And number four, a net charge for positions in options where appropriate. In this regard, the capital charge will be calculated on the basis of the following consideration. Firstly, bank underlying trading issues may exist in long or short and both. For trading issues related to only long position, then the total capital charge is to be calculated using the capital charge weight. And then where any transaction related to both long and short position, the total capital charges is to be calculated. Moving to the next slide. In the maturity method, long or short positions in debt securities and other sources of interest rate exposures, including derivative instrument and slotted into a maturity ladder comprising 13 time bonds. Fixed rate instruments should be allocated according to the residual term to maturity and floating rate instrument according to the residual term to the next repricing date. Securities which have already matured and remain unpaid for more than 60 days should be treated as non-performing asset. Therefore, it should attract relevant risk weight. That's all for today. Thank you very much.
Hello, Assalamu alaikum. This is Rudra Sarkar. My student ID is last 3 digit 160. Today I will discuss four very important topics. First one, repo transaction. Second, interest rate derivatives. Third, calculation of position. And fourth, forward rate agreement. So let's get started. My first topic is that repo transaction. So what is repo? Repo is a financial transaction where the one party sells security to another party with an agreement to repurchase the same security later date at higher price. This is called repo. In the repo transaction, the party who sell the security is called borrower and the party who buy the security is called lender. My second topic is that interest rate derivatives. What is interest rate derivatives? Interest rate derivatives is financial transaction whose value depend on change in interest rate. Some common type interest rate derivatives are interest rate swaps, collapse, flourish, swaption. The interest rate derivatives can be used to convert fixed interest instrument into floating interest instrument. My third topic is that calculation of position. Calculation of position in the case of derivatives refers to determining whether an individual or entity hold a long or short position in a derivatives context. Long position means an individual or entity has bought derivatives, and short position means an individual and entity sold the derivatives. My last topic is that forward rate agreement. So what is forward rate agreement? Forward rate agreement is a contract between two parties to exchange interest rate for a specific period. Thank you.
Assalamu alaikum. This is Ahmed Ashraful Alam Shihab, and my student ID is 2010737162. Today I am going to talk about measuring the foreign exchange risk in a portfolio of foreign currency position. The overall foreign exchange exposure is measured by aggregating the sum of net positions or the sum of net long positions, whichever is greater regardless of sign. Then we are going to know measurement of risk-weighted assets, operational risk. Operational risk is defined as the risk of loss resulting from inadequate or failed internal processes, people, and systems, or from external events. This definition includes legal risk but excludes strategic and reputational risk. Methods for calculating operational risk. The first method is the basic indicator approach. Uses the bank's total gross income as a risk indicator for the bank's operational risk exposure and sets the required level of operational risk capital as 15% of the bank's annual positive gross income. The second method is the standardized approach. In the context of operational risk, the standardized approach is a set of operational measurement techniques proposed under Basel II capital adequacy rules for banking institutions. Basel II requires all banking institutions to set aside capital of operational risk. Thank you very much for staying with me. Have a great day.
Hello everyone, this is Ronnie Howladar. My student ID is 2010937164. Today I am going to show something about the supervisory review process. Let's move to the slide. The supervisory review process recognizes the responsibility of bank management in developing an internal capital assessment process and setting capital targets that are commensurate with the bank's risk profile and control environment. The aspect of a rigorous supervisory review process are as follows. Basically, the aspects are board and senior management oversight, sound capital assessment, comprehensive assessment of risk, monitoring and reporting, and the last one is internal review control. The risk related to supervisory review process. There are many types of risks which are related to supervisory review process, mainly residual risk, concentration risk, liquidity risk, reputation risk, strategic risk, and the last one is settlement risk. Now, the other material risk. Other material risk, supervisory review process requires that the bank's internal capital allocation process should cover all risks which have not been identified earlier but are material for the institution. The institution needs to consider all risks not specified above, but it can be captured in institution's operation and can be regarded as material. Risks may be appeared which are specific to the institution and derived from its non-standard activities and clientele, but fall outside the scope of specified risks definition under Pillar 1 and Pillar 2. I hope everything is clear about the supervisory review process. Thank you, everyone.
Assalamu alaikum. This is me, MD Shakil Ahmed. My user ID is 2010237165, Department of Banking and Insurance at University of Rajshahi. So today my topic is about supervisory review process. So in the supervisory review process, we can firstly see the liquidity risks. So what is liquidity risks? Liquidity risk is the risk of loss resulting from the inability to meet payment obligations in full and on time when they become due. In the liquidity risks, regulatory liquidity indicators are given below, such as cash reserve requirement, statutory liquidity ratio. Then secondly come the reputation risks. So reputation risks refers to the losing reputations or goodwill in society due to various reasons, such as non-compliance to regulatory norms, getting stuck in legal cases, force bad publicity. Then third come the strategic risks. Strategic risks refers to the internal and external event that may make it difficult or even impossible for an organization to achieve their objectives. And strategic goals, that risks can have sharp consequences that indicate organizations in the long terms. Then come the settlement risks. Settlement risks is the possibility that one or more parties will fail to deliver on the term of a contract at a agreed upon time. It also type of counterparty risks associated with default risks as well as with timing differences between parties. Then next is appraisals of core risk management practice. Bangladesh banks introduced core risk management system for assessing the risk management environment and practices in Bank 2003. Lastly, the environmental and climate change risks. Environmental and climate change risks refers to the uncertainty or probability of losses that originates from any adverse environmental or climate change event. Okay, so that's all from my side. Thank you everyone to view this video. Assalamu alaikum.
Hello everyone, this is Fatimata Jora. My bearing ID is 20120371166. Today in this video, I will discuss the last two supervisory review process, stress testing and capital planning. The last two supervisory review process are monitoring and reporting and internal control review. In SRP review process, the bank should follow the following aspects of monitoring and reporting. Firstly, establish a robust capital framework. Second, implement regular capital risk assessment. Third, enhance data management and reporting capabilities. Fourth, develop comprehensive capital risk reporting. Fifth, incorporate scenario analysis and stress testing. Sixth, foster a strong risk culture. Internal control review. The bank should conduct periodic review of its risk management process to ensure its integrity, accuracy, and reasonableness. Areas that should be reviewed include: firstly, appropriateness of the bank's capital assessment process given the nature, scope, and complexity of its activities. Second, identification of large exposures and risk concentration. Third, accuracy and competitiveness of data inputs into the bank's assessment process. Fourth, reasonableness and validity of scenarios used in the assessment process. And fifth, stress testing and analysis of assumption and input. Stress testing. A bank stress test is an analysis to determine whether a bank has enough capital to withstand an economic or financial crisis. Stress tests focus on a few key areas such as credit risk, market risk, and liquidity risk to measure the financial status of banks in a crisis. Some variables of stress test are interest rate, unemployment, GDP, equity and debt markets, exchange rate, real estate prices. Capital planning. Capital planning is a dynamic and ongoing process that, in order to be effective, is forward-looking in incorporating changes in a bank's strategic focus, risk tolerance levels, business plans, operating environment, or other factors that materially affect capital adequacy. Some key steps of capital planning are strategic plan, financial forecast, capital assessment, capital actions. That's all for today. Thank you everyone.
Assalamu alaikum everyone. I'm Mohammad Ashraful Islam, currently studying at Banking and Insurance Department in University of Rajshahi. The last 4 digits of my bearing student ID is 7134 and I'm a 19th series student. Today my assigning topic is supervisory review evaluation process. So let's start with the introduction. The supervisory review evaluation process, or SREP, is a comprehensive assessment conducted by banking or financial institutions. It not only regulates or evaluates but also ensures the safety and soundness of other financial institutions as well. Moving forward, there are principles of SREP of Bangladesh Bank, which includes review and evaluation of banks, minimum regulatory capital ratios, prevent capital from falling below, and business model and strategy. Bangladesh Bank not only evaluates but also uh, uh, helps bank to attain their organizational goals to as their compliances. Minimum regulatory capital ratio indicates that Bangladesh Bank expects other banks to hold a minimum capital ratio. Bangladesh Bank also intervenes in other banks for to prevent the capital from falling below up to a minimum level, and also it provides business model and strategies for other banks. Moving forward, there are SRP dialogues such as preparation and initiation, discussion risk profiles, assessment of capital adequacy, review of governance and risk management, stress testing, and scenario analysis. Capital and liquidity adequacy reviews institutions' ability to absorb, process, and maintain adequate capital levels. The government risks examines effectiveness and government structure and risk management practices. Business model analysis evaluates whether the business model is institutions substantial or valuable medium in long run or not. Stress testing uses hypothesis adverse scenarios to evaluate the reliances and institutions capital and liquid positions. Moving forward, there are terms and reference of the dialogues, which also includes minimum capital requirement against credits, the risk deriving from economic and regulatory environment, adequate capital against comprehensive risk, stress testing exercises and results. Methods. There are basically four methods of SRP, which are review of adequate risk assessment, assessments of capital adequacy, assessments of the control environment, and assessments supervisory review compliances with the minimum standards. That's all from me today. Thank you.
Assalamu alaikum. I'm Naid Michel Bapi, plus 4 digit of my student ID is 7137. I'm a student of Department of Banking and Insurance, University of Rajshahi. My topic is market discipline. Market discipline. The purpose of market discipline is to receive capital adequacy framework is to complete the minimum capital requirement and the supervisory review process. And the main of introducing market discipline is to revised framework is to establish more transparent and more disciplined financial market so that stakeholder can assess the position of a bank regarding holding of assets and to identify the risks relating to the assets and capital adequacy to meet probable loss or asset. And second is relation with accounting disclosure. It is expected that the disclosure framework does not conflict with a requirement under accounting standard as set by Bangladesh Bank for time to time. Moreover, bank disclosure should be consistent with how senior management and the board of directors assess and manage the risks of the bank. Under minimum capital requirement, bank will use specified approaches, methodology for measuring the various risks they face and the resulting capital requirements. It is it is believed that providing disclosure that are based on a common framework in an effective means of information the stakeholder about a bank exposure to those risks and provide a consistent and comprehensive disclosure framework of risks its management that enhances of comparability. And third one is disclosure framework. The general equality disclosure requirement. For each separate risks are bank must describe their risk management objectives and policies, including strategies and process, the structure and organizing of the relevant risk management function, and the scope and nature of risk reporting and or measurement system, policies for heeding and or mitigating risks and strategies and process for monitoring the counting effectiveness of headaches militigant. And thank you.